presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact YouTube update for September 10th, 2024. I'm Mo Ansari, President of Compact Asset Management. Thank you for joining me today. Make sure you go to the YouTube to get this YouTube update. Whenever I post it, you will get a notification simply by going to compact.com/media. Compact.com/media. Go and register, put a like button on this one, so whenever I do one, you will be notified. Today we are going to talk about, well, it's a big day today. We've got the debate coming up tonight. That's going to be big. It's going to be, I think, give us some clarity. Might give us some idea. I don't think it's going to be a knockout like the last debate was. Both sides are going to put the spin on it. As long as there's no knockout, we're okay. If there's a knockout one side or the other, that could create some volatility in the market. So we'll see how that goes. We have a lot of data coming out this week. We do have the Fed meeting next week, and I'll talk about all of that in a little bit. Looking at the numbers last week, worst week in the market in nearly a year and a half. The S&P down 4.22%. The NASDAQ was down even more, 5.76%. Year to date now, the S&P is doing better than the NASDAQ. NASDAQ is only up 11.75 for the year. S&P is up nearly 14.5. The one that is disappointing last week was the Russell, down big, down 5.67%. That's not a good, that's what I talked about earlier on in the summer when we were talking about the market. So I said, look, keep an eye on when we get a correction, we get a pullback, how do those small caps hold up? Javed and I are going to talk a lot more about this on the podcast later on today, so make sure you're a subscriber to the podcast so you'll get a lot more detailed view of what I am talking about right now. But that was disappointing as far as the Russell. Surprising, last week, the biggest downside mover was technology, down 7.1%. But the surprise is utilities are the best sector this year, up 21.9%. As interest rates come down, utilities go up. But there is another factor why the dull, boring utilities are up nearly 22%. We'll talk about that on the podcast and let you know why utilities could be an AI play. Wait a minute. Yeah, artificial intelligence. We'll talk about it in the podcast, so make sure you tune into that, why utilities are being a beneficiary of the AI boom. Oil below $70. It's down again big today. Is it a slowdown? Is it a recession? Is that what is causing oil to come down? No, I think it's the premium, the war premium coming out of oil. As I talked about 2 years ago on the broadcast that I did daily, on the radio broadcast, I talked about that, where I thought that the oil flow, the direction of oil flows will change. It took a couple of years. The oil that used to go from Russia to Europe. That's where Russia exported. But because of the Ukraine war, all the sanctions that placed on Europe, all the Russian oil started to go to China and India. China and India were the largest importers of oil from the Middle East. Now the Middle Eastern oil, a lot of that is going to Europe. So the oil flows have changed. The oil that used to go from Russia to Europe is now going from Russia to China and India. And the oil from the Middle East that used to go to China and India is going to Europe. So that's what we're seeing. So the oil premium, the war premiums that were there, just the oil flows have changed. Now we're going back to a regular market. We are the largest producers of oil right now. We're producing more oil in the United States. China is slowing down, which is the largest importer of oil. And that's why I think we're seeing, people are saying, well, oil is going down because of global slowdown. Well, we are slowing down here in the United States. We did see the unemployment data come out last week. We were expecting 165,000 jobs created, only 142,000 created, but not bad, better than the month before, but that month before was 114. That was even revised down again to 89,000. So unemployment is starting to go up. Employment is starting to slow down. What is the Fed going to do? They're going to cut interest rates next week. 25 basis points is the expectation. If they do more than that, that'll be a surprise to the market. If they cut rates by 0.5% instead of 0.25%, that could be a surprise to the market. And I don't know how the market will interpret that. Is it because the Fed is worried about the economy slowing too much? Or is it because the Fed wants to front load it and be preemptive on this slowing of the economy? That will be debated, but lower interest rates are always good for the market. That's what we're going to see. And interest rates are moving lower. They're below 3.7 right now. We talked a lot more about this. They've gone from 3.9, the 10 years, to 3.72. 3.8 was the number that we were looking at last. That was a low in December of last year. That was the market hit a low. And interest rates started to go up a little because everybody was worried about a slowdown, all of that. Rates started to go back up, market stabilized. Now we're down to 3.65. We're below today, below the 3.72, below the 3.8. Is this due to a fear of a recession? I think it's just a slowdown that is happening in the market. And as long as we don't see a breakdown in the canary in the coal mine, which is the indicator of a recession coming or a real slowdown, that is the high yield bond market. We talk about that on the podcast today. Javed talks about that a lot, and we'll talk about that today. But we're not seeing that, so I'm not worried. And that's what we're seeing. Tomorrow we get the CPI expected to be 0.2. And that's inflation at the consumer level. Then we get inflation at the wholesale level, expected to be pretty benign. I don't think we see any big change there in rates, in inflation. And I think, again, the Fed has moved the focus from inflation to unemployment. They're saying we've got two mandates: keep inflation down, keep employment up or unemployment down. And so they are now moving away from inflation and talking more about employment. Looking at the technicals, we have broken below the 50-day moving average. It was 55.05. We see this line right here, this red right here. We broke below it on Friday. We were up a little bit yesterday. But inside day, where the whole bar, this green bar right here, is inside this red bar right here. That's called an inside day in the market, and it shows a continuation. Today, we're testing this 50-day moving average. We're right at about 54.85 or so. We've got to get above 5,500. But looking at the weekly chart of the S&P, where each one of these vertical red and green lines are 1 week of trading instead of 1 day, you can see how I talked about this red line a couple of weeks ago, and that was support. We came and held it, bounced off of it. It is 54.25. Today we're at 54.84. As long as we stay here, then this could have been the fourth wave pullback. As we say, everything moves in 5 waves: wave 1, wave 2, wave 3. This could have been wave 4, and then we move towards wave 5, which is up here. So we start moving, but I think we'll bounce around here for a few weeks before we start moving above that 5750, 600, 5650 area, which was the all-time high. NASDAQ, different story. We're below the 50-day moving average, below the 20-day moving average. Today, we've got to get above 17.5, this blue line right here, for me to get excited. We're about 17,000 today. On the downside, 16.3. This line right here that you're seeing right here is the 200-day moving average. As long as we stay above that, we're below this, we're just stuck in a range going back and forth, and that's what we expect to see. My dot plot, this right here, as long as these dots are above the market, this is the market, these vertical lines, red and green, that's telling me that we're in a downward trend. We saw this right here, where my dot plot got above the market. That was last October of 2023. But when we turned up, we broke out, the dots got below this right here. We stayed up just about a whole year, from December till about here. Now we've turned down 6-7 weeks, so I expect another couple of weeks of sideways before we can get to the dot plots and turn positive again. Yield again broke below here, the 380 we're looking at. We broke below that, and we're down to here today. We're 3.65. And again, I think that's due to expectation, economy is slowing, and that will cause the market to come back. The interest rates are expected to be cut next week, and that's why the market is adjusting to it. Oil down big today. at about $65 a barrel, down $3 a barrel today. But this could be the final low right here. Fifth wave bottom again. One wave down, two up, three down, four up, five down. So we should be coming into a bounce here, back up to the 20-day, which is about 73. But we're pretty much on the downside and exhausting. We could go more down a little bit, but we're bouncing, getting closer to a bottom. Small caps, as long as they hold 208, we're right there today, 207.71. We're holding this 20-week moving average, but small caps have been disappointing. They should have held up better on this decline that we saw last week and the week before, but we're not. So oil small caps might not. The lower interest rate should have benefited the small caps, but we'll discuss why we think small caps are not doing well on the podcast later on today. Gold just bouncing around this 20-day moving average, 25.43 today, 25.32 is the 20-day moving average, this red line right here. Again, I think gold long-term should be heading higher as long as we don't go into a recession. That's the way we're looking at it. Those are my thoughts. Those are my observations for this week. Again, if you'd like to get more information, go to the podcast. It's about a 30 or 45-minute conversation. Javed and I talk about all of what I've talked about in a lot more detail, but you can see the charts here on YouTube. When I talk about them on the podcast, you can go back here and take a look. Again, if you want us to help you with your portfolio, do a free analysis, no cost or obligation, send us an email at invest@compact.com. That's with a K, invest@compact.com. Send us an email or just give us a call at 800-388-9700. Those are my thoughts. Those are my observations for this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moees Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.